Joining me now is Stacy Rasgon, Bernstein Research Senior Analyst for U.S. Semiconductors. And Stacy, what's relevant here in terms of the market reaction to a really big revenue miss and, arguably not that profound a stock decline of more than 6%, and also what it means going ahead. Is this kind of a one-time shock, or we have to worry about numbers coming down next year?
Yeah, so you're right. It's not that big of a stock reaction in the wake of a fairly sizable cut. And the reason is most investors have been waiting for this. The signs in GPU land have not been all that supportive recently. Everybody can see the weakness. They can see the retail prices coming down. We can see crypto imploding and all of this. So I think investors have been broadly expecting a cut. The question was, were we going to get it like now, or were we going to have to wait till the earnings call, which is in a few weeks? I'm actually happy to get it now. I think if you're going to clear the decks, just go ahead and clear the decks. And it is a very sizable cut to your second question. I think the hope is that hopefully the bottom can be in. It was very similar to the flush that we saw at the end of calendar 18 on the prior crypto bubble bursting. I think at that point their gaming business was down 46% sequentially. It looks like now it's down 44%. And that last cycle was the bottom. It actually grew sequentially off of that. It took about 4 quarters to get back to where it had been sort of pre-flush. And we didn't have the follow-on gaming cycle that back then. Ampere, which is their next gen, was still 18 months out. We've got another gaming cycle for these guys coming in the relatively short order. It'd be called Lovelace, I don't know, end of the year, maybe into next year. But they're just clearing the channel out in front of it. They're just clearing the deck. So I think taken in that context, this is a good thing. Better to do it now than later. And the stock reaction today kind of supports that.
Are those fully distinct product areas, gaming and crypto? You sort of seem to blend them together a little bit there. Do they move in a similar cadence because of how people use these chips?
Well, crypto is probably a component of the gaming business. We don't actually know how much, neither do they. And so we've had weaker demand for GPUs. I'm sure that crypto is a piece of that, but it was going to go away anyways, even if crypto had not imploded. Ethereum is moving from what's called proof of work, which requires a lot of compute power to do the mining, to proof of stake, which does not. And it's been pushed out, but it's going to happen before the end of the year. And at that point, any crypto demand for the GPUs was going to go away anyways. This is actually one silver lining. We still don't exactly know what the real run rate of gaming is going to be going forward. But whatever it is, this is the last crypto cycle for NVIDIA. We shouldn't see any more after this because you won't be using GPUs to do the Ethereum mining after this. And data center, which actually was, data center was a little weaker on supply chain issues, but it's still objectively very strong, much bigger than gaming. This is no longer going to be a gaming-driven company. It's going to be a data center-driven company.
You were, I think, penciling in what you thought might happen to consensus for next year in the $5 a share type range, 5.5, something like that. Where does that leave us with evaluation? I mean, the stock's been cut in half, but obviously the forecasts have been declining alongside it.
Yeah, so if you were just to annualize the cut and just reduce everything going forward by the same amount, you'd get an EPS, a floor EPS of probably $5. That may be a little too aggressive because it's likely that some of what we're seeing is inventory flush. So they're by definition under shipping, and you do have some product cycles coming along. So call it like maybe mid 5s might be something that's realistic, and the stock's probably trading low 30s on that number, which is not cheap, but at the same time, like low 30s for NVIDIA on what's likely to be a trough earnings number. With the long-term story around data center and like autos killing it now and software and everything else, it's not an egregious multiple to pay up for a trough earnings number for this stock. So it's not cheap, but it's not egregious either.
And I assume that if this is a rerun to some degree of what you saw in late 2018, I mean, that clearly was a great time to enter.
It was actually with the stock sort of treaded water for a little while after that in the beginning of first half of 2019. What actually started running again was when data center looked like it at the bottom. Because you got to remember, during the last cycle, we had a data center cycle as well. It also rolled over. At this point, data center growth slowed a bit again on some of these supply chain issues, but it was still up 60% year over year. It still looks okay. As long as data center is holding in, and I think it can, especially with some of the product cycles that are coming, I think this can be a good time a good opportunity. We'll see what they have to say in a couple of weeks when they report.
Yeah, we sure will. Stacy, thanks a lot. Stacy Rasgon, appreciate it.